And investment managers are trained in modern finance and understand risk management. So there's a professionalism to all of this. The family is of limited, even if it were smart, even if they were brilliant as investment managers, they're a small unit. And unless they were to engage in some kind of risk-sharing agreement, they can't manage risks well. The whole family is too small a unit to manage risk. But increasingly, investment managers are running risk management for families that allows risk-sharing around the world. We have growing pains with this. The recent financial crisis shows that investment managers mess up sometimes, and their attempt to share risks around the world, like, for example, the subprime crisis was caused by the failure to manage mortgage risk appropriately. But nonetheless, I think they're getting more professional and more important. So right now we have professional risk managers that are, I think, increasingly important in our very lives. Now, they have a fiduciary duty. If you are managing other people's money, that's a quote, other people's money, then you might be negligent. It's not my money, what do I care? So the law prescribes that you, as an investment manager, have a duty to act in the interest of the person you're managing for, or of the group of people you're managing for. And the law has been trying to prescribe what this duty is. There is something called the prudent person rule. Which is a rule that investment managers have to behave as a prudent person would. I'll read one definition of it. ERISA, which was an act of Congress in 1974, defined, they called it prudent man rule back then because our language was still sexist in 1974. They said that investment managers running pension funds must manage with the care, skill, prudence, and diligence under the circumstances then prevailing, that a prudent man acting in a like capacity and familiar with such matters would use in the conduct of an enterprise of a like character and with like aims. Okay? They're trying to legislate what it is to be a good fiduciary. And it seems sensible. You should ask, if someone is managing a pension fund for elderly people, they shouldn't do wild and crazy investments, right? They shouldn't invest in racehorses or something like that. Should be prudent. But then how do you define it? If you read the Act, it says they would be acting like a prudent man in a like capacity, in a conduct of an enterprise of a like character and with like aims. The problem is, with the 1974 Act, is that it's hard to legislate duty, define what it is. So what the law said, and it has said in many places, is that you have to, as a fiduciary, as an investment manager, you have to act as a prudent person would act. And what is a prudent person? I guess it's somebody else. I mean, somebody else who is of a kind of a standard, ordinary type. I don't know what it is. I mean, I could say that investing in racehorses is the smartest thing for me to do, but I can't claim that that's a prudent person act. So the law has required institutional investors, to some extent, to behave as, not as they would behave, but as they think other people would behave. It was legislating a requirement that you don't do what you think is smart, you do what you think other people think is smart. And this has been a problem because what it has done is it has created a class of institutional investors who live in fear of laws that could come down on them if they, with the best of intentions, invest on behalf of their clients in an unconventional way, and therefore could be punished for violating the prudent person rule. Thus, for example, because of the prudent person rule, university endowments, which are an example of institutional investments, for much of the 20th century were invested in bonds, government bonds, because they thought, well, that's prudent. No one can tell me that we're not prudent. The government bonds is safe. Some investment portfolios, notably the one that we had David Swenson come and speak to us earlier, took a more aggressive interpretation of the prudent person rule and developed an investment strategy that looked imprudent. So, for example, Yale University was investing in startup .com firms during the .com explosion, managed to sell out just at the peak. Is that being a prudent person? Well, the interpretation of prudent person rule has changed, and this is part of the phenomenon that drove the bubble. Institutional investors, led by people like David Swenson, led to a more benign interpretation of the prudent person rule and allowed them to take chances. And I think that general sense that one could be more aggressive in investing was part of the bubble that led to the financial crisis. I'm not saying it's a bad thing in itself, but I'm telling you it was part of the factors that led to this bubble. I looked through Dodd-Frank. The Dodd-Frank Act of 2010 is the most important piece of financial legislation in the United States since the Great Depression. And I did a search for prudent person. It appears nowhere. But I found that the word prudential standards appeared 34 times in the Dodd-Frank Act. So it seems like the financial crisis is changing things a little bit. It's bringing our society to want regulators, government regulators, to be making the ultimate decisions about what kind of risks institutional investors will take on. They're still letting households do what they want, but in terms of institutional investors, the Dodd-Frank Act talks extensively about regulators going in and regulating what institutional investors, what kinds of risk they can take. The same thing is true in other countries. I think this is a world phenomenon. The problem is that the prudent person rule didn't seem to work. It didn't seem to work well enough. It started out when it was first imposed as encouraging a very conservative investment, but then people thought as time went on that didn't make sense. They got more loose, and it led to a financial crisis. So Dodd-Frank is creating something called the FSOC, the Financial Stability Oversight Commission, which has to enforce, well, it doesn't enforce, but it makes recommendations on prudential standards, particularly regarding, well, I'd say particularly, but including leverage. Leverage, we talked about, is the amount of money you borrow. Well, it's measured. It's a measure of the risk that you've imposed on your portfolio by borrowing to buy assets. The economy became increasingly leveraged up until the financial crisis when it began around 2007. And people are concerned about that. Well, were our institutions following the prudent person rule? Somehow as time went on, their mind allowed more and more leverage to be considered acceptable. So now what we have in the Dodd-Frank Act is that the Financial Services Oversight Commission is supposed to recommend standards of leverage and prudential standards for financial corporations, and to put financial corporations under increasing regulatory authority to meet those standards. So in some sense, it's shifted to the government. We had seen a historic shift of power over investments from individual investors to institutional investors, and to some extent at least it's shifting to the government. Okay. And I think I'm talking mostly about the US, but I think this is a currently worldwide trend. You know, it's exemplified also, I mentioned before, that we had private organizations, the securities rating agencies, such as the Moody's and Standard & Poor's and Fitch. But the government are trusting them less, and they're putting standards more on government regulators now. I said I would talk about financial advisors. Financial advisors are people who don't directly manage portfolios. They're not institutional investors, but they give advice to those who do. The financial advisors are regulated by governments in most countries. So in the U.S., for example, the SEC, the Securities and Exchange Commission, requires advisors to be approved by FINRA. To win FINRA approval, where FINRA is the successor to the National Association of Securities Dealers. It's a non-government organization that administers an examination and education program for advisors. And so you effectively have to go through FINRA to get licensed to be a financial advisor. Okay. I'll give you an example of an organization of financial advisors. NAPFA is the National Association of Personal Financial Advisors that manages the interrelation between financial advisors and the public. So these people will typically charge between $75 and $300 an hour, and you can get one tomorrow. Just make a phone call, get on the website, NAPFA website, and hire one. And they have a code of standards. They have to be licensed to the SEC, and they have to have a code of standards, oath of loyalty to the client that they undertake. This is a big business. I'm mentioning it because I think I gave some, in one of my first lectures, I gave you a count of how many people there are. But I'm just trying to, there's also something else called a financial planner. Financial planners. Now it sounds like the same thing to me, but somehow if you call yourself a financial planner, you don't have to go through this licensing. The Dodd-Frank Act, I didn't find much new legislation regarding them. The Dodd-Frank Act is calling for a study of financial planners. Question is, how does the government get involved in making these people give good advice? The problem is that the financial crisis seemed to be led by a lot of bad advice given out. A lot of people were encouraged to leverage up their ownership in their home, to borrow heavily to buy second homes. I'm sure that financial advisors were not uniformly advising that, or financial planners, But there's a concern now about what kind of advice people were given. So in 1996, Congress passed a bill in the United States saying that financial advisors cannot be convicted felons, among other things. But there hadn't been, until then, such a law. We have something else called mortgage brokers. It's a little different. These are people who give advice on getting a home mortgage. There was no licensing of them until the financial crisis, because mortgage brokers could be anything. They could even be a convicted felon until just a few years ago, until after the crisis. Here's the fundamental problem, that people are they're confronted by an increasingly complicated financial structure. Living is less family, and it's more investing and getting involved in financial markets, and most people don't know how to do it, and that the people who give them advice are often not giving them the best advice. What can we do about that? Well, the government is trying, but it's imperfect. I think that as the world develops, I think we'll probably see, I think there is a trend toward increasing professionalization of these groups. And although it's not a simple matter to straighten out some of the irregularities, we're moving, as the world gets better and better, to even stronger such institutions. I wanted to talk about pensions, because I've already talked about them, but people do get old and they can't keep working. And if you look at the history of the world, the fate of elderly people is highly variable. Many of them, if they have good and dutiful children, will do all right, who take care of them. But in the past, you would find a lot of elderly people out on the streets begging because they didn't have children, or the children died, or the children lost their income. And it's a problem that we've worked substantially to solve. And again, it's an example of progress of our civilization. We take it for granted that people are living as comfortably and well as they are, but it's substantially a product of invention. So the idea of a pension is actually a relatively new idea. The first U.S. Pension plan was 1875. American Express Company set up a pension plan for its employees. There is actually an earlier example in the UK, I think, but I don't have the name of it here, but only something like 20 years earlier. So until then, there was never a pension plan. So American Express set up a plan, and it said employees who had worked at, this, by the way, is not the credit card company. This was a delivery company. They had stagecoaches. This is a long time ago. If you worked there for 20 years, past age 60, and was disabled, you would get 50% of the average of the last 10 years' pay for life. So this was a model, 50% of last 10 years, of average of last 10 years pay on retirement, because it was tied to how much income. You thought you could live on half the income that you earned when you were working. In 1901, Carnegie Steel, that's Andrew Carnegie, the same Andrew Carnegie who wrote The Gospel of Wealth that we've been talking about, gave this was the first large industrial pension fund. It covered a substantial number of people. It was a milestone that suggested many more such pension funds. Unions in the early 20th century started setting up pension funds. For example, the pattern makers in 1900, the granite cutters and cigar makers in 1905, etc. So union pension funds became popular in the early 20th century. But there was a collapse of pensions after 1929. Many people were promised pensions in the first 3 decades of the 20th century, and the companies just went out of business and didn't. Moreover, the unions' pension funds failed especially disastrously. They just didn't. They didn't manage their money well, or the institutional investors were not very astute. You know, it's like the world was very amateurish about how they handled these things. Obviously, it's very important that people have money to retire on, but they just many of them got wiped out in 1929. So it led to further thinking about pensions. The General Motors pension plan was a landmark pension plan in 1950. And in 1950, GM Chairman Charles Wilson proposed a fully funded pension plan. This was a new idea. That is, General Motors, in promising to pay you in your retirement, would set aside and invest now enough money so that they would have that. In other words, they created a trust for the employees. So it's just like the parent for the handicapped child. If General Motors dies, doesn't matter because there's a trust managing their pension funds. You know, it's kind of a funny idea. Why didn't anyone do that before? Why didn't the unions, who were looking out for the union employees, demand that they fund their pension funds? You know, it seems like financial history shows a lot of stupidity. I don't quite understand how it could be. It seems obvious, doesn't it, that if a company is going to promise you for a pension, that they should set aside money, because companies fail all the time. There may have been some union complicity, that the unions were not really always working on behalf of their members. They thought, well, the members don't think about this problem, so we're not going to think about it either. It's going to come years down the road. We're not going to worry. So General Motors in 1950 set an example for funding the pension funds. It's very important. And more and more firms started to do that after 1950. But the next thing I want to give is Studebaker. You remember Studebaker? They were one of the major automobile manufacturers. Maybe you don't remember them because they went bankrupt in 1963. That's a long time ago for you, but they were around. Well, they had a pension plan that was partly funded, but inadequately funded. And when they went out of business, their employees lost. So this led to arguments about, and their labor union, again, the United Auto Workers, supposedly standing up for the employees, didn't do the job. So the whole idea of labor management, negotiating, protecting the workers seemed flawed. And so the government got involved. And it led to ERISA, which I mentioned before, 1974. ERISA stands for Employment Retirement Income Security Act. This was an act to clean up pension funds and make them work well, make them work better. So the government wanted to make sure not only that pension plans said they were funded, but that they were really funded, so that another bankruptcy wouldn't cause pension plans to fail. So ERISA set up a new government agency called the Pension Benefits Guarantee Corporation. So that's PBGC. The Pension Benefits Guarantee Corporation is a government organization that ensures the funding of pension plans. Okay? So pension plans not only have to undergo scrutiny by the PBGC that they are fully funded, but they also have to pay a insurance premium to the PBGC, and if it turns out that they're not fully funded, then the PBGC will come in and replace the lost income. So you see how over the century we're trying to come up with financial structures that solve basic human problems. The PBGC, by the way, is still here, and it hasn't gone bankrupt despite this financial crisis. Though people are worried about it, it has managed to survive. After 1974, shortly after this, after 1974, a new kind of pension plan became popular. So ERISA was written in an age of defined benefit pension plans. Okay, like the original American Express pension plan. What did American Express pension plan in 1875 promise you? It promised you half of your average income for the last 10 years. All right? And if you're going to fund a pension plan, you're presenting a problem to the managers of the pension money. They have to hit that target. They're told you the pension plan has an obligation to fund the payments equal to whatever percent of last year's income. And that's kind of a tricky problem if you're a manager. How do I do that? How do I hit that target? How do I know how much money to set aside? Well, it's getting now into government regulators and prudent person rules, and it's tricky. But the point is that in 1974, almost all pension plans were like that. They defined the benefit that you would receive when you retired. But in the 1980s, companies started offering a new kind of pension plan called a defined contribution. The idea was, it's hard for us to hit that target of, say, 50% of your average income for the last 10 years. How do you expect us to do that? We don't know how much these investments will pay out. We don't even know how much money you'll be paid in your last 10 years. So, it's asking us to do the impossible. So, well, it's not impossible, to do the difficult. So many companies decided, instead of requiring a defined amount to be paid, they would just define the contribution they'll make to your portfolio. They give you a portfolio as an employee, and you get whatever income that portfolio generates when you retire. The most famous example of that is a 401k plan in the United States. But ever since, shortly after ERISA, the world has been moving toward defined contribution pension plans, where a defined contribution pension plan doesn't promise what you'll get in retirement. So then a portfolio manager for a defined contribution pension plan doesn't have to worry about hitting targets. And in fact, the way defined contribution plans are usually set up, they give the individual employee the choice of the main portfolio allocation between stocks and bonds and real estate or whatever. But you have investment managers managing within one of those asset classes. So there'll be someone managing an equity fund, another one managing a bond fund, and they try to do as well as they can as investors, subject to the restriction of what they invest in, and it's left to the client to choose the allocation. Defined contribution plans are going through growing pains too. We still don't have the perfect system. The problem with defined contribution plans, one problem is that you don't have to sign up for them the way they've been set up. It used to be, under the old days, defined benefit plans was just automatically every employee would get the pension plan. But with a defined contribution plan, the typical rule was that the company would ask you to make contributions out of your paycheck to the plan, and the company would then match them, typically, with additional contributions. But something like a quarter of the people would choose not to participate. And then, just because they're not thinking, or they're not thinking ahead. And so when they come to retire, they don't have any pension plan. Moreover, some of them take the most risky investment offered. They might put it all in the stock market. And if the stock market does badly, they might end up poor in retirement. And companies generally would not give any advice to the people who were employees because they didn't want to be liable for giving bad advice. So it led to kind of amateur investing for pension plans. There's been work to try to fix that, and I think we've now, federal legislation has made it easier for companies to give advice to employees. They've also allowed recently, in the last few years, for companies to automatically enroll employees in a pension plan and allow them to make allocations if they didn't hear anything from the employees. In other words, they'll put you into a prudent allocation, and then you're actually there. You're in it because you've said nothing. So that's working toward solving the problem. We still don't have, I think, the ideal solution to any of these things.